South China Morning Post, 16th of March 2024, China intends to stop obtaining iron ore from Brazil and Australia. Africa holds the key. The lengthy supply path and the U.S. Navy's lack of security for Chinese commerce lines pose the greatest threats to Chinese goals. Despite being a small nation on Africa's Atlantic coast, China hopes to eliminate its reliance on Australia and Brazil for its iron ore needs. This includes Sierra Leone. Australia and Brazil supply more than 80% of China's iron ore needs, but Beijing wants to reduce the risk associated with that supply. And the nation of West Africa, together with Guinea, Liberia, Cameroon, and Congo-Brazzaville, is essential to achieving it. Leone Rock Metal Group, a subsidiary of Chinese mining and metals corporation China Kingho Energy Group, is building a 12 million ton iron ore processing plant at the Tonkolili iron ore mine in the northern region of Sierra Leone for $230 million. The mine contains an estimated 13.7 billion tons of iron ore. In the meantime, following 27 years of false beginnings, Chinese investors and the British-Australian mining behemoth Rio Tinto are expected to ship the first iron ore from the Simandou mine in neighbouring Guinea early next year. Simandou is the world's largest untapped deposit of high-grade iron ore. This comes after the National Transitional Council, Guinea's parliament, decided to enact laws ratifying the $20 billion deal, which will see the creation of a port and railway in addition to iron ore exploitation. The Mammoth Project, with an annual production capacity of 120 million tons, has also agreed to receive investments from Chinese state-owned enterprises, including the steelmaker Baowu Group. The Mbalam-Nabiba project, which aims to exploit extensive iron ore resources that cross Cameroon and neighboring Congo-Brazzaville in central West Africa, also receives funding from Chinese enterprises. Additionally, a group of Chinese businesses is investing in the Guarjabilat iron ore mine in the western Algerian province of Tindouf, and in December, Baowu shipped the first iron cargo from its flagship Bomi project in Liberia. According to analysts, these are only a few of the African mining initiatives that are part of China's Foundation Plan for Iron Ore, which tries to mitigate the country's vulnerability due to its reliance on Brazil and Australia for the resource. According to Liz Gao, senior analyst in iron ore at commodities consulting firm CRU Group, China's investment in Africa was an attempt to diversify its sources of iron ore. She also mentioned that almost 80% of the world's seaborne iron ore shipments came from Brazil and Australia. According to Gao, China's long-term goal of enhancing its position in the global iron ore trade by taking a larger ownership stake in overseas iron ore supply includes the significant investment made abroad. Currently, we calculate that around 5% of the world's iron ore supply is owned by Chinese companies. Regretfully, according to Gao, a large portion of this material was among the most expensive to obtain globally. As a result, the steel mill's pursuit of more competitive assets, such as Simandou, made sense. According to Lauren Johnston, an associate professor at the University of Sydney's China Studies Centre, China's investments in Africa indicate its resolve to reduce the risk associated with its iron ore supplies. She stated that China wished to become less dependent on its largest supplier, Australia. She stated that although China's surge in mass infrastructure and real estate development slowed, the country was still making more significant strides in pursuing high-value manufacturing. The Simandou deposit in Guinea contains the world's highest-grade iron ore, which Johnston stated would benefit this goal. According to her, one reason Australian iron ore was preferred over West Africa was the higher expense of shipping it to China, which is why ports were crucial to Africa's growth. The Lekki Deep-Sea Port, a massive port constructed by China in Nigeria, is located somewhat outside Lagos. According to Johnston, the port would probably accept smaller freighters transporting iron ore from Guinea and Sierra Leone, which would be loaded onto more giant freighters and shipped to China. According to Johnston, Australia's cost competitiveness over Brazil, currently the second largest supplier of iron ore to China, has traditionally been primarily attributed to its larger freighter size. According to Gao of CRU Group, the high risk involved in building infrastructure, such as ports and inland transportation, and the comparatively limited availability of electricity and power made introducing these products to the market expensive. For this reason, constructing power lines, ports, and railroads required financial support from Chinese investors. In addition to ownership conflicts and political unrest in Guinea, the Simandou mine experienced numerous delays due to the absence of a railway, which compelled the project's participants to construct the necessary infrastructure jointly. The coastal town of Pepple, where bulk iron ore is exported, is receiving an infrastructural improvement thanks to a $153 million investment from Leone Rock Metal Group. According to Gao, if Simandou started operating, it would likely replace some iron ore shipments to China and Australia. However, those countries would still hold a significant market share to China. In actuality, we think that the suppliers that are farther away from their clients and have higher costs will bear the brunt of this. Regretfully, several of these mines are controlled by Chinese companies, Gao stated. According to her, Simandou would place Guinea as the world's third largest exporter of iron ore by bringing over 120 million tons of iron ore to the market annually. Gao said the high-grade favorable Simandou would be favored when steel margins were favored. Steelmakers would still choose lower-grade ores to control their productivity in the current scenario, where they are struggling with weak margins, making ores from Australia preferable, the spokesperson stated. Former Liberian Minister Gidmore, a senior policy scholar at the Center for Global Development in Washington, stated Beijing was unwilling to cede its standing as the world's largest steel producer. China's intention to maintain its leadership in steel manufacturing is evident, which could be a reaction to the country's slowing economic growth. Moore claimed that China was increasing its focus on manufacturing due to its already developed infrastructure and the slowdown in the real estate market. He stated, their plan may include access to minerals and other manufacturing inputs. However, this isn't easy to see as a near-term strategy. He also mentioned Australia's dispute with China. Australia was a crucial trading partner for China and a security alliance for the US. Therefore, diversifying supply sources was necessary for national security and commercial reasons. One imagines that African sources are a good replacement or backup for Australian ones, Moore said, adding, Africa is relatively friendly for China. 2020 saw a deterioration in China-Australia relations as the outgoing administration demanded a global inquiry into the coronavirus's source. Due to the dispute, Beijing imposed taxes on several Australian goods, including wine, barley, seafood, and meat. Following Prime Minister Anthony Albanese's election in 2022, relations somewhat improved. According to Johnston from the University of Sydney, over the next 10 years, most of the steel demand is expected to move to Africa due to the continent's need for infrastructure such as vehicles, trains, homes, bridges, and highways. More iron ore may remain in Africa as a result, a possibility for which some Chinese businesses have already made plans. A $1.5 billion steel facility is being constructed at Manhise, south of Harare, by Dinson Iron and Steel Company, a Zimbabwean subsidiary of the Chinese company Tsingshan Group, which manufactures nickel and stainless steel. Additionally, China Kingho Energy Group, one of the most prominent privately held energy organizations, pledged to construct a steel plant in Sierra Leone to process iron ore in 2025 during President Julius Maada Bio of Sierra Leone's state visit to Beijing earlier this month. According to Johnston, it's possible that not all of the iron ore will be shipped to East Asia, as in the past few decades. She added that it relied on how much it cost to produce steel in Africa, how quickly economies expanded, and how much electricity cost. That explains the investments made in Ivory Coast, Guinea, and electricity projects in Sierra Leone.